Despite the long list of risks such as high stock valuations, weakening jobs data, geopolitical tensions, trade frictions, inflation pressures, and ballooning government deficits, markets are holding up remarkably well. Stocks are rallying, gold is strong, and even some bonds have bounced back. So why aren't investors panicking? Today, we're going to break down the reasons behind this market resilience and also what it might mean for your portfolio. Today's video is sponsored by Trading 212, a UK commission-free investment platform. Let's be honest, the risks are real. On paper, you'd expect markets to be nervous. Yet when we look at the data, investors are showing exactly the opposite. Confidence levels that we haven't seen in years. So what's going on? Let's go through the key drivers. One important factor is investor complacency. State Street's Risk Appetite Index, and this is based on buying and selling patterns of institutional investors across 22 different risk dimensions. That's close to a 5-year high, and that shows that institutional investors, so that would be pension funds, hedge funds, insurance companies, they've tilted heavily towards risk. Equity allocations are now at their most aggressive since late 2007, and that was of course just before the financial crisis. If we look at what US households are doing, they're currently holding 70-year record allocations to stocks. And that reflects a very punchy attitude to risk, and it's understandable given the duration and the scale of the US equity rally over the last decade. And it's not just data to do with positioning, it's also things like the VIX Volatility Index, also called the Fear Index. That's been stuck below 20% for extended periods. And that suggests investors see very little need for insurance. Even Jamie Dimon of JP Morgan has warned that markets have fallen into extreme complacency. Now, before we look at other reasons why markets are grinding higher and whether and why it'll stop, I'd like to talk about Trading 212's ISA, and today's video is sponsored by Trading 212. I've been using Trading 212 Stocks and Shares ISA for a few years now, and I love the platform, and this is why. Firstly, it charges no account fees or any monthly or annual subscription fees. Secondly, it offers lots of choice for my fund portfolio, which is what I've got on Trading 212. Trading 212 offers over 13,000 ETFs, but also stocks from the UK, US, Canada, and Europe. And as part of its functionality, it offers fractional shares, pies, and auto investment. And if I had to choose my favorite feature, it would probably be pies, where you can create portfolios within your ISA. If I want to rebalance one of my pies, I can do it with a single click. Furthermore, you can reinvest your dividends back into the pie, and that's another form of rebalancing. Now, Trading 212's ISA is flexible, and that means that within a tax year, you can withdraw cash and put it back into the account without affecting your ISA allowance. Now, as a viewer of PensionCraft, you get a special offer from Trading 212 where you can claim free fractional shares worth up to £100. Just open an account, verify it, fund it, and then use my name as the promo code, which is RAMIN, R-A-M-I-N, and you'll also find a link to that offer in the description below. Now, psychology is a really important driver of this rally. And in that rally, markets are climbing the so-called wall of worry. Investors hear the risks, but over time they just get desensitized. Several behavioral biases are behind this. One of those is herding behavior. When everyone piles into risky assets, momentum feeds on itself. There's also anchoring bias. Investors are conditioned to buy the dip, and that's because of recent strong performance. For global index investors, for example, it's been over a decade since the strategy of buying the dip hasn't worked. And all of us have a tendency towards selective perception where we choose to focus on bullish data while brushing off bad data. There's also a deeper way of looking at this, and that's the market mind hypothesis. This was proposed by Patrick Skatanos, and it suggests that markets behave like adaptive learning entities that absorb shocks, digest narratives, and generate emergent intelligence. In this view, crashes, bubbles, meme stock frenzies are not anomalies, they're expressions of a collective market brain which amplifies emotions and reorganizes capital faster than any individual can. Economists like Schiller, Lowe, and Bouchot make a similar point. Markets are better understood as living, thinking systems rather than some form of mechanical calculator. Narratives, expectations, and reflexivity, that's George Soros's idea that perception drives outcomes. All of these mean that markets don't just reflect fundamentals, they mirror collective psychology. And as AI becomes increasingly entwined with markets through algorithmic trading, but also sentiment analysis, we may be heading into a new era of intelligence squared, where human cognition and also machine learning reinforce one another. That could mean more efficient capital allocation or greater fragility if feedback loops spiral. The Federal Reserve is also a huge factor. Even after the recent rate cuts, the Fed has been careful to stress it can adjust policy to support growth but also employment. And investors interpret this as a kind of protective umbrella, the famous Fed put. In other words, if the economy wobbles too much, the Fed will step in, and that perception reduces anxiety and also encourages more risk-taking. And we can't ignore earnings. For all the talk of recession and inflation, corporate profits in the US have held up surprisingly well. In the second quarter of 2025, the S&P 500's profits or earnings grew by over 10% year on year. The forecasts also look quite strong, either in line with or above the 6% or 7% historic growth that we've seen over the last decade. And the reason for that strong profit growth is that companies have managed inflationary costs, but also supply chain disruption around tariffs much better than many people expected. The sector structure of US markets is also important. The US equity market, which is about 2/3 of the global equity market, has a very lopsided sector structure. And you can see that lopsided structure in this graph, which is taken from our website at PensionCraft, and premium website members get access to this. The size of these boxes shows you the market capitalizations of individual stocks, but also the sector that they belong to. And the shading here is the return over the previous year. So green is positive and red is negative. Note that the largest sectors are the ones with the most positive returns, as the narrative around AI has gained steam. In contrast, sectors where returns have been poor, such as consumer staples, energy and healthcare, are relatively small in comparison, and that in turn means they've got less influence on the overall index's return. And finally, one of the market narratives right now is the taco trade, which stands for Trump always chickens out. The acronym was coined by Robert Armstrong this year, and the idea is that the US administration doesn't have a very high tolerance for market and economic pressure, and it's going to be quick to back off when policies like tariffs cause pain. Now, markets have learnt that pattern. They no longer react to the threats with the same fear that they once did. Instead, traders assume that the rhetoric will soften, deals will be struck, or deadlines are going to get pushed back. In practice, it lowers the risk premium investors demand, and it also helps explain why markets remain calm, even against a backdrop of big political uncertainty. The risk, of course, is what happens if the pattern breaks. If there's ever a moment when Trump doesn't chicken out, markets that have grown accustomed to fading the threats could be caught off guard, and the adjustments would be sudden and painful. So the taco trade explains part of today's resilience, but also builds fragility into the system as it stands. So for now, at least according to markets, everything is okay. But is this about to end? Here's the big caveat. Just because markets are calm now doesn't mean they'll stay that way. An elevated risk appetite, high valuations, and low volatility often lead to sharp market corrections. Markets are currently betting on three things: continued Fed support, strong corporate earnings, and geopolitical tensions easing. If any one of these assumptions breaks down, the optimism could unravel very quickly. And history shows when sentiment flips, it tends to happen suddenly. But here's an important point. Valuation is a poor timing signal, and markets can stay expensive for years, so there's no need to make any drastic changes based on valuations alone. But if you find yourself lying awake at night worrying about a market tumble, that's a signal that your portfolio may carry more risk than you're truly comfortable with. And remember that the best time to adjust is when markets are at an all-time high, not in the middle of a market crash. Shift to a level of exposure you can live with for the long term and then stick with it. That way, you avoid being caught up in complacency, but you also avoid the panic of making bad decisions in the heat of a downturn. Now, a lot of people that I speak to at the moment are worried about this downturn and they just don't think markets can grind higher. So please tell me if that is your concern also in the comments below. And don't forget the sponsor of today's video, Trading 212. There's a special offer for PensionCraft viewers where you can claim free fractional shares worth up to £100. Simply open an account, verify it, fund it, and then use my name as a promo code. That's Ramin, R-A-M-I-N, and you'll find a link to that offer in the description below. And, as always, thank you for listening.